hey.
Yeah. Tonight, on an all-new edition of What Are Your Thoughts, Michael and I reveal the next bank to go down.
Berkshire? Are they as safe as we think?
Can you imagine if this was a show like that, though? It's like, we will reveal.
Seeking Alpha does it. I mean, there's some spots.
Oh, it's all garbage. If you don't listen to us, I don't know who you're listening to, but it's probably a scam. We're the real guys. We are the real guys. All right,
a lot of great content people out there. Stop it.
True. We are not going to call for any bank runs. We're not going to instigate / predict any specific bank runs tonight. However, I would point out traffic on this channel is absolutely booming. So if you wanted to cause a bank run, we don't want to be involved in it, but we would just say it's okay with us. Like if you were to do that, it would be okay with it. Am I
higher the VIX, higher the clicks. No, listen, in all seriousnness, thank God we could joke about this.
We're saying that like we like bank runs as long as nobody actually loses money, but a lot of things get clicked. Am I still over the line?
Stop it.
Duncan, Duncan, as my media attorney, what are your thoughts on what I've just communicated to the American public? Bad? Don't say any more?
Probably.
All right, maybe just stop talking. All right, today's show is brought to you by Y Charts. I use Y Charts quite literally all day, most every day, even on Sundays. If you are a listener of What Are Your Thoughts and you would like to take Y Charts for a spin, put your hands on the steering wheel, so to speak, you've got to the end of March. No credit card required. Free access to the site. Tell them you know us. They'll give it to you. All right, let's move on.
What a pitch. I love it. I'm in. If I weren't already a Y Charts user, I'd be all in. Okay, tonight's a big night. We're gonna start. We're pretty much all covering almost everything's the same story now. It's all like mashed up together with what's going on.
Remember inflation?
LOL. We got CPI. We'll get into that. So this is like a really big humiliation for Silicon Valley. I think the crash of the SPACs and the crypto and the NASDAQ and the IPO market was like a humbling. And then this is like a step beyond the humbling. And I don't think that anybody has anything to like be humiliated about. It's just like that's really what this moment is. This is the biggest, most important bank for that whole ecosystem, and all of the commentary around it, and all of the people that left huge uninsured deposits there, and even the way the bank itself was being managed, and all of the incitement to run from the bank, like just all of it is embarrassing. And I think it's a nice reminder that no one's as great as they think they are or as we think they are. And in the end, like, you will eventually be humbled in this life and ultimately maybe even humiliated, which is the case right now. What are your thoughts?
I don't know that I necessarily see it that way. Who do you think was humiliated exactly?
I think,
and I'm going to ask you to name names, but like in general.
Let me give you some names. No, I think a lot of people were operating under the auspices of, I am a venture-backed startup CEO, or I am a VC, or I am like the mayor of Silicon Valley, and we're so great. It's just low interest rates. Like, you're not so fucking innovative. It's free money for 10 years. Like, everybody benefited from it. We benefited from it. Like, I'm not saying that only tech geniuses benefited from cheap money. I'm just saying, like, a little bit of acknowledgement that cheap money makes everybody look smarter than they are would be nice from time to time. And now we have actual proof that free money makes people look smarter than they are, because nobody looks that smart if they had 12 portfolio companies banking at Silicon Valley and no access to funds from anywhere else. Like, you're just not that smart. Even if you got out, even if the government backstopped it, you're not that great.
You know who does look pretty smart right now? I was talking to Ben about this, and I think they deserve a little bit of credit, more than a little bit. A lot of the people that were warning about the distortions that low interest rates create really over the last decade and some have been more extreme than others. I think it's their time to shine a little bit, more than a little bit. They were warning of this, and I think one of the things that I did not anticipate as a result of low interest rates was what happens when interest rates go from 0 to 450 in 12 months. I don't think anybody necessarily saw that coming, but this idea that the danger would come from within the bank, like treasuries being the source of risk, I did not see that coming.
Yeah, that's what's so fascinating about this. Look, banks fail all the time, not in recent memory, but just like historically. It's not very frequent that a bank will go down because of its exposure to 10-year treasuries. That is really,
I mean,
that is
that
like, that's something else.
It wasn't subprime garbage that took them down. It was it was United States treasuries.
Go look at the big bank failures. None of them went down from doing what did not. Now, there are still people that are like, oh, the duration. Yeah, all right, relax. Yeah. It wasn't 30-year treasuries. Yeah. It wasn't even 10-year, corporate junk bonds. Like, let's relax.
It was mortgage-backed securities, and it was poor execution, obviously, but that's what it was. Jake Chervinsky tweeted something that I think is worth talking about. He said, I honestly can't believe how many people are so filled with hate for the U.S. tech sector, despite using its products and services every day, that they'd rather see tens of thousands of people go unpaid than see the SVB failure resolved. Ideological cruelty has gotten off the charts. And somebody responded. I'm glad they did. I think this is just Twitter's echo chamber. Most people aren't like this. And Jake responded, I hope you're right. And I think that it gets so fucking twisted.
Put that back up.
Being on Twitter and being on social media. I think this is the truth.
Yes! Yes! This is what I'm trying to tell you. You can take this off. You have a choice. Be successful and shut up, or be a striver who hasn't yet found success and tweet your head off. But you can't do both. You can't be a billionaire and then also bludgeon people with your opinions about everything all day long. I mean, you can, but everyone's going to hate you. That's exactly what this is. If you meet one of these tech people and you're from a different walk of life, if you meet one of these people in real life, you don't hate them. You're not mad at what they do for a living. You're cool with it. Oh, cool. You innovate. Oh, great. You work in semiconductors or so. Great. It's the online thing. Shut up. Get off Twitter. Stop bothering people with your face and your bullshit and all your opinions. If you just do that, you will not have this level of blowback. But people in the tech world literally can't do that. They cannot stop talking. It's not just tech. Hedge fund manager. Oh, I have opinions on Russia, Ukraine, epidemiology. I could tell you all about what should have happened with monetary policy. I'm also an expert in banking. It's like you got to get to a certain point where it's like, all right, you know what? I'm really successful. I do well. I have a nice life. I don't also have to treat people to my opinion on everything under the sun all day on Twitter. And I think there's a few people that have probably learned something from this week, and maybe we'll pull it back. So maybe that's the silver lining.
Let's talk about what happens next for banks. Tracy Alloway put it very succinctly, and she's spot on. A bank with subpar risk management and flaky depositors just changed the U.S. financial system forever. I think that this is a clear line of demarcation. We said this last night. There is a before SVB and after. It will never go back.
True. No, there's no. How could you? All right. Let me ask you a question. Pittsburgh, community bank, a community bank that happens to cater to a lot of people who work in the steel industry and a lot of steel companies. And all of a sudden, steel prices crash to 8 cents a bucket or whatever. I don't know how they measure, what is it, a ton? Whatever.
I believe it's shucks.
Okay. What are you going to do? Tell these people, oh, you lost your deposits? Like, oh, no, you don't understand. Silicon Valley Bank depositors, they're working on really important issues like dog walking apps. You're not, your deposits, I'm sorry, you shouldn't have trusted that bank. Like, you will never again see the depositors of a bank lose their money in the bank. Never again.
So let me ask you this. By the way, I really do love Pittsburgh. I was upside surprised. I spent some
trying
time
to come up with an example. Like,
all right.
There's no.
But listen. So over the weekend, I was talking to Ben and I said, all right, recession. Like if if there's a mass exodus out of regional banks and into the giants, the JP Morgans of the world, credit will deteriorate. There will not be as much loan activity. There just won't be. And we're going through a recession. However, the government stepped in, as I believe they absolutely had to. If they didn't step in Sunday morning, they would have stepped in by Monday morning because it would have been pandemonium. So I think they did the right thing. Modest Proposal tweeted, no matter how SVB was resolved, large deposits were going to move from banks that needed them to banks that don't, from small and regional to money centers. So credit will tighten and many banks need new funding sources. BTFP meant to buy time, but markets are pressing the issue. Okay, I actually disagree. This is how I thought, but I disagree. And I hope I'm right for the sake of our country. I think that now that the crisis has been averted, I think that inertia will set back in. You're shaking your head. I think that maybe 5% of money will move? Yeah, maybe. Is there going to be a mass exodus out of regional banks? I don't believe so.
I think it's now going to be a covert exodus where it's less frantic. It's not lines outside of banks or anything like that. But I think it's inexorable. At this point, you are just going to see a slow and steady drifting of assets.
No way.
Away
no
from.
way.
I'm telling you.
In 3 months, okay, listen.
And do you want to know why? Very simple reason.
Just because you say it twice doesn't mean you're right. Go ahead.
No. Very simple reason. The smaller banks will not be able to do what the larger banks are able to do. And it's not about, I'm panicking, I think my banks could go under. It's like, why bother dealing with a bank that doesn't have as good technology because
Inertia.
they're local?
Yeah.
Why? Because I could drive past the building when I feel like
yes.
it? Does anybody really care about
relationships.
That?
Yes, they do. Relationships. It matters. So listen, if there's another bank failure tomorrow, next week, forget what I said. It's over.
Oh, so the first two, but the third can't happen?
Well, there was a third, but as long as there's not another wave, if there's not another failure, if somebody's not moving today, why are they going to move in 60 days from now? They're either moving today or they're not.
I don't see it that way.
You think in 3 months, 4 months, 8 months from now, there will still be a slow trickle? Dude, inertia is massively positive.
Let me put it to you
Powerful,
this way.
I should say.
Let me put it to you this way. You are an entrepreneur who has just spent the last week digesting all the headlines, all the hysteria, the tweets, everything that you just saw.
Yes.
You're about to start a new company 5 months from now. Job number 1, establish credit and a bank account for my new company. Where are you going?
I agree with you there.
Okay. Well, so that's how it happens. It's the panic phase is over. Now it's a new mindset. There is no advantage to dealing with a local bank if all things are equal, and for a lot of people they are. I'm using the app anyway, not showing up in person, don't care about the relationship, already have money from somewhere else, don't need the funding. And no one else, by the way, what local bank, you telling me Comerica is going to start writing venture debt checks now? You telling me like...
No. Well, let me ask you this.
You think First Republic is taking meetings?
So I think the knee-jerk reaction that I had is that's going to be really bad. Why is that bad? And I honestly don't know. Why?
Because it concentrates more of America's capital amongst a smaller group of banks. It's not.
I know that sounds bad.
Ideal.
I know that sounds bad, but why is it bad?
It's just bad. Ask a European. They don't have 5 million community banks spread out all over France or Germany. They have these banks that are almost quasi-state-run banks, and they're not run well.
But all else is not equal. It's not just about an app. It is about relationships. People do care about their local banks.
Let's go to the comments. Here's Archie Bunker says, why should they insure more than they said they were going to insure? A fool in their money or lucky to get together in the first place.
Okay. I get that.
Tyrone, I got caught. Shout to TR. I got caught in the SVB mess and still won't go to a larger bank. The inertia isn't with it for early stage companies. Okay, so there's somebody that takes your side.
So I understand the sentiment about the ballot. I do. But you have to understand a few things. The equity went to zero, number one. Stop, let me finish. The taxpayers are not funding this. The banks pay for the insurance. The depositors got backstopped. If we expect citizens of this country to be forensic accountants before they open a bank account, what are we even doing?
we can't expect that. It's ridiculous.
All right, so the question that I have for you is
right. You want a person to walk into a bank and ask the teller what's the average duration on your bank's treasury portfolio? That's not ever going to happen.
But
agree.
I will say the bank's
That's why
fucked
I'm
up.
going to be right. That's why I'm going to be
fucked
right.
up, and not just SVB. Banks aren't. You know who should be competition for banks? Treasury bills. It shouldn't be J.P. Morgan versus
Yes.
SVB. It should be J.P. Morgan versus the Treasury. Pay me some money. The Fed funds rate at 450 basis points. Pay me some money. Look at this chart, please. Chart on, please.
Go ahead.
Exhibit 2, John. So, okay, the dark blue line is the Fed funds rate, and the light blue line is the U.S. checking account national average. Pay me money, or I'm leaving. I'm leaving.
Well, now we come to the real issue, which is the reason why there's so much pushback against a central bank coin, for example, like a digital U.S. dollar issued by the Treasury or administered by the Fed. The reason why there's so much pushback against the Fed actually serving as a bank directly to the consumer is because this would vaporize the need for there to be a bank. If you had the ability to open an app, Fed Direct, and literally give money to the Federal Reserve to hold for you in exchange for the actual interest rate of a 6-month T-bill or a 10-year Treasury bond, what would you ever need a bank for? And
it does
of course,
exist.
No, it really doesn't. You cannot bank that way. You cannot bank that way. Buying treasuries is annoying enough. Imagine if you could make deposits one-on-one directly with the Fed. Now you can't, so it doesn't matter. That would end the banking system virtually overnight.
Well, in
Think
2
about
weeks,
that.
I'm talking with Brandon Aronofsky from Meow, who we invested in, full disclosure, about what they're doing there. So more to come on that. All right, but this is going to get political real fast. It already is. So Elizabeth
Warren was already like screaming on MSNBC last night.
She said Fed Chair Powell's actions to allow big banks like Silicon Valley to boost their profits by loading up on risk directly contributed to these bank failures. Give me a fucking break. It was bad management. Risk? They're not buying SPACs. They were buying treasuries and mortgage-backed securities. It was negligence.
All right, so her narrative, and I don't think she's 100% wrong here. Her narrative, though, is that we had Dodd-Frank 15 years ago, approx 13 years ago, in order to prevent banks from doing whatever they're doing without oversight. And then in 2018, the Trump administration rolled back the level at which banks qualified for that level of heightened supervision. And Silicon Valley was one of those banks that previously was being stress tested, and then it wasn't. And it only took, this is her perspective, from 2018, it only took 5 years to go out of business. So maybe what they were buying was not the risk. Maybe there needed to be a stress test of what happens if rates are higher and you're losing your depositors. That sounds reasonable. It doesn't matter. Nobody was doing it, internally or externally.
How's this for a fucking take from the Wall Street Journal, Andy Kessler? Was there regulatory failure? Perhaps. SVB was regulated like a bank, but looked more like a money market fund. Then there's this. In its proxy statement, SVB notes that besides 91% of their board being independent and 45% women, they also have, I don't know whether these quotes are on this, 1 black, 1 LGBTQ, and 2 veterans.
Hold
on. Here's a coup de grace. I'm not saying 12 white men would have avoided this mess, but the company may have been distracted by diversity demands. So this has gotten out of fucking control. They're blaming the wokeness. I mean, this is just, it's insanity.
Well, if you write that for the Wall Street Journal, that is exactly what their audience wants to read. And then the New York Post will pick it up and do an even more like caricatured version of that. And then they start saying, oh, well, this bank was celebrating, this special interest group. Therefore, they took their eye off the ball.
Yeah, come on. Give me a break.
That's not really part of this at all.
I want to share some quotes from Ken Griffin because he has some thoughts. This is the 33rd richest man in the world, worth 35 some odd billion dollars. The U.S. is supposed to be a capitalist economy, and that's breaking down before our eyes. Oh, really? Excuse me. Is this not capitalism? The equity went to zero. The risk holders got wiped out. He goes on to say, there's been a loss of financial discipline with the government bailing out depositors in full. It would have been a great lesson in moral hazard. Losses to depositors would have been immaterial. What? Yeah, easier for you to say. You have $35 billion. And it would have driven home the point that risk management is essential. Risk management for fucking regular people that are opening a bank account? What are we talking about?
He wants capitalism, but he doesn't want to have Citadel show up in an auction for the right to execute trades at the lowest possible price. So there are some elements of capitalism that he would like walled off from competition and survival of the fittest. He really does love the idea, though, of a little league based in California having their savings vaporized because of the moral hazard. It's a really
I understand moral hazard, and I think that I'm not completely dismissing it, but in this case, it's a straw man. We have to protect the depositors. Hard stop.
Yeah, listen, I think that the problem here is that now we're going to always have to do it. So Griffin is not wrong about that. Like, we have definitely changed the rules overnight. There is
the game changed. The game changed.
No shit. So now, don't tell me FDIC is 250. No. The new limit is whatever it takes so that depositors don't lose money. And that's not the world we were in a week ago. And I heard Mohamed El-Arian talk about that this morning. I think that's like, now that the bomb has gone off and we saw what the damage was and whatever, now there's like a quiet. And nobody has really fully processed what it means that the government is now de facto backstopping every deposit at every U.S. bank in every region for every citizen. It's a new world.
The last time we did a major overhaul to the financial regulatory system in 2008 or whenever the laws were changed, we didn't have mobile phones like this where you can move $42 billion off a bank in a day. So, we'll see where this shakes out.
Maybe it's time. We're operating under bank and securities laws that were, for the most part, created in the 30s and 40s. Maybe it's time for us to say, oh, wait, $42 billion can come out of one institution in 24 hours? That doesn't sound like the sort of thing that's been addressed by our 80-year-old banking regulations. Let's take a fresh look. It's up to our generation to do that now.
What if we do lockups for depositors?
Honestly, the easiest solution is the fucking meteor just hits the earth and it's just enough. Like that, the easiest way for this all to progress is just to end. That is the way out of this all. All right. What are we doing next? Is it me? We done
I just have to say, the list is always right in front of you on the screen.
Oh, wait. I want to do Cam Harvey. I love him. Campbell Harvey. All right. He put something out that I thought was worth reviewing. It's kind of like an inverted yield curve flavored take, which, of course, why wouldn't it be? For those of you guys who are not familiar, Campbell Harvey is the godfather of the inverted yield curve indicator, not the curve itself, but the actual indicator. And this is something that he said, quote, a broader issue, a deeply inverted yield curve potentially puts other banks at risk. A positively sloped yield curve where long rates are higher than short-term rates is good for bank health because banks generally pay short-term rates for savings deposits and receive long-term rates on their loan book. In aggressively raising short rates, the Fed has upended the normal model. Other banks could be at risk. The Fed urgently needs to assess this possibility. Okay.
But wait, they don't pay short-term rates. That's the thing. They pay so
barely
far.
Do.
They pay no, they literally don't. They pay so far below what the market rates are, and that's the problem.
Yeah, so this is his next point. The largest banks have market power. They can pay 0.48% interest on savings deposits when T-bills are yielding 4.5%. The next tier of banks cannot do that and must pay nearer to market rates. Thus, we are seeing the failure of banks most have never heard of. I think this is still a very important point.
Yes.
And I think it's going to get worse. Like if you're Bank of America, you could probably get away with a ridiculously low rate right now in a way that the community bank of Simi Valley or whatever, I'm making shit up, just is not able to do. And that matters today. It really does. And I think you're going to see deposits continue to move. And I don't really know that there's a solution to it, to be honest with you.
It's tricky. Oh, thanks, Barry, for FaceTiming me right
now. Moody's cuts banking sector outlook to negative, which is just in time. I'm glad they got this done after the average bank is, I don't know, down 40%, 30%. What's the number? All right, quote, this is Moody's. These are the guys that cut all the banks after Lehman Brothers crashed, which was equally helpful. We have changed to negative from stable our outlook on the U.S. banking system, whole system, to reflect the rapid deterioration in the operating environment following deposit runs at SVB, Silvergate, and Signature.
Who is this helping?
Hold on. They put 6 institutions under review. Pull your fucking money out immediately, by the way, when you hear that. Zions, Western Alliance, Comerica, Intrust, First Republic, and UMB. Quote, we expect pressures to persist and be exacerbated by ongoing monetary policy tightening, with interest rates likely to remain higher for longer. They're new to this. Until inflation returns to within the Fed's target, U.S. banks are now facing sharply rising deposit costs after years of low funding costs, which will reduce earnings at banks, particularly those with a greater proportion of fixed-rate assets. That's the bear case for banks going forward. You might say, haven't we seen the worst? No.
Are banks going to become uninvestable?
I think they're going to turn into utilities. I said this last night. Utilities have to get permission from the state they operate in to raise rates. It's called a rate case. And every 3 years or every 4 years, they go back in front of the municipality and they present their case for why they should be able to raise the amount they're charging. And they will say, we have a higher cost of this, we have to employ this many people, we're working on this this project to improve life for your citizens, etc. Give us a rate increase. And the state will say, yes or no, you can increase your rate. That's where the banking system is headed if there is this implicit guarantee on all deposited cash.
Josh, great minds think alike. Alex slacked me yesterday. Banking seems like a really shitty business to get into. This is at 4:40. I said, going to be worse going forward. They're going to raise FDIC and limits and just completely kill the bank's ability to make money.
Alex who?
Our Alex. So I said they're going to be like.
Yeah.
I said they're going to be like utilities.
I don't see any way around it. Let's talk about the last time the Federal Reserve encountered a situation like this, where for the purposes of containing inflation, they wanted to hike rates, and then they hiked and hiked and hiked until something blew up. In 1994, there was a rate hiking cycle that resulted in Orange County, the actual county, going bankrupt. And it was a very similar situation. And Joe Terranova reminded me of that yesterday and sent a couple of charts out. These are very simple charts, but I think worth thinking about. Greenspan basically hiked until he broke something. This is the S&P 500 in December of 1994 going into 95. You could see it bottoming out here. Let's go to the next chart and you'll understand why. Here's the 10-year U.S. Treasury, and you see it peaking out. You see this
it peaked when stocks bottomed.
Look at this. Look at how steep the rate was rising in January, February, March. There was a little bit of a pause that spring, and then summer into fall, and you get the 10-year up to 8%. You blow up Orange County. They're offsides on their bonds, and before you know it, the Fed is now lowering rates. And Joe is pointing to that parallel as something we should think about. It's a very different situation than Volcker. And I think there's a tendency for us to compare what Jay Powell is doing with what Volcker was doing in the early 80s. But this one might actually make more sense. If this is the thing that gets the Fed to stop, it would be very Orange County-like circa mid-1990s.
Two things there. Oh, I was just talking to Derek Thompson. Ben and I are going to be on his podcast tomorrow. And as
Not
we're
to
wrapping,
brag.
as we're definitely not to brag. We don't do that here. As we were wrapping up, he made an interesting point because I was talking about the reverse Minsky moment. Will the instability that we just saw lead to stability with the bank, with the federal bank saying, "All right, I think we're going to chill." What if we dodged a huge bullet? What if there wasn't a bank run, and the Fed kept going, and let's say they did 50, which is what the market was pricing in. We're about to get to that. What if this allowed the Fed to know that they went too far before they really went too far, and instead of it being SVB, it was fucking Wells Fargo that blew up?
So I'm of the view that Wells Fargo could not have blown up because they have a much more diverse base of depositors.
You know what I mean? I'm using Wells Fargo. Not even forget about maybe not even necessarily a bank, but just something bigger than SVB. And SVB was big.
I mean, I feel like this is the 16th largest bank in America. It's big enough, I guess.
But my point is big. The economy. And sorry for all the F-bombs were charged up. The economy can survive this.
I am not sorry. Yeah, no, it's right. I agree with you there. Like it could have been worse.
Like what if instead of it being SVB, it was like, I know the housing market is frozen, but what if the housing market literally blew up? I don't even know what that would look like. The point is, we might have dodged a bullet. They might have found out early enough, even though it feels like it was too late.
Actually, what could have been worse? You saw the price action in Schwab yesterday. What if all of a sudden Fidelity, Schwab, E-Trade, Morgan Stanley, Bank of America, securities, like the brokerages, got to a point where money was flying out the door? Because then you're talking about a whole different flavor to this kind of scare. Like just as an example, Schwab, I think, lost almost half its market value in a week. They have $7 trillion in assets under management. I don't know how many clients. Could it be 100 million clients? Is that possible? 80 million, 50 million?
Huge number.
That would have been, not that I'm saying I thought that was imminent, and full disclosure, I own the stock now. But like that kind of thing, you're right. It's a good thing we didn't get to the point where it's like a major Wall Street brokerage / bank. You're right about that. I agree with that.
Let's talk about Fed funds. What does this even do? I feel like this is the first meeting that we've had in over a year, maybe longer, where we really don't know, right? It feels like it's not decided. So anyway, I want to talk about...
Oh, I know.
All right. Yeah, you know. All right, let's talk about... Fine, go ahead. Please explain it. I mean, you might be right. What, they're going to pause?
Yeah, I think there's no reason to do it. They got the CPI. The CPI report gives them cover to just not say we're done, the cycle's over, but probably pause and then never hike again for as long as we all live. No, I think it's it.
I think they got 25, but okay. I don't have strong. I wouldn't
fall out of bed.
Okay, so the gravity or the steepness of the curve hiking was insane. Chart on, please. So prior to the 80s, it was monetary policy that determined where the rates were. Like market, they adjusted the monetary supply, and then the Fed funds rate did what it did based on that. It wasn't until the 80s where they started giving like ranges, upper and lower range bound on the Fed funds rate. So that's why this chart doesn't go back to like the 50s. Okay, so look at the red line, which is the most recent hiking cycle.
So the bottom is months since the cycle started. So this is 12 months.
We started in March. Yep.
It's 12 months to get to 4.5%. Is, first of all, wait. So it's not. So that's not just 4.5%. We happen to have started from zero. That's just 450 basis points.
That's correct.
Right. Because these don't all start at zero. Most rate hiking cycles did not start from zero historically.
It's too much, and we learned
should
that
never
now.
be there. And really, right. The problem was being on zero as late as March. of 2022.
So
right, that's really the issue.
By the way, this is not revisionist history, and I don't think we deserve credit. Pretty much everyone was saying, "What are they doing?"
No, dude. Yeah, I agree. It's easy. It's easy to be like, "Well, how did they know?" Like,
it was consensus at the time. Yeah, it was consensus at the time.
It was consensus in 21. Why are you still stimulating real estate?
Were they buying $40 billion worth of mortgage bonds a month?
They were buying $120 billion worth of bonds on top of 0% interest rates, on top of sending cash into people's bank accounts.
Yeah. I think it was 80. Yeah, I think it was 80 of treasuries, 40 of mortgages.
What did you think was going to happen?
Okay, so now there was a ton of economic volatility. The interest rates are going bananas. The probability of a 25 basis point rate hike.
Look at this.
So it collapsed 2 weeks ago as data was coming in stronger. We said, "Oh shit, they're not doing 25; they're going to do 50," and then that went the other way. But after today's meeting, Josh, the implied Fed funds rate is actually on the rise. So it looked like maybe they were just going to pause yesterday, and now it looks like they're going to go 25. I don't know. Obviously, we'll find out
because of the bank rescue.
Well, because that chilled people out, and then CPI came in a little bit hot. Not too hot, but
I'm going to tell you right now. Nobody has chilled out. We haven't even begun.
That's not true.
No. nope. We haven't even begun to see the layoffs. I'm telling you, the Fed knows it. Everyone knows it. This is a disinflationary shock.
That's a different story, and I agree with you there. Let's stick with Treasury volatility. This is from Mike Zuckerberg. Highest since the GFC. This is not good. I mean, this is really, really not good. There's one thing. It's one thing to see stock market volatility. It's another thing to see it in the interest rate environment. Not good. Jim Bianco has a great chart showing the change in the U.S. 2-year yield over a 3-day period. The last time we saw something like this was 1987. You saw something in 2001, post 9/11. You saw something like this during the GFC. I mean, this is like historic moves.
I made a really bad call. I said that this year Treasury bond volatility was going to fade away throughout the course of the year. Maybe it will, but the first quarter is definitely making me look like a jackass because the volatility in Treasuries is just incredible to me.
I've never seen anything like this in my career.
Yeah. So very, 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 very wrong call on my part. I did not think that we were still going to be doing this this late into the year. So I kind of thought a lot of this was behind us. So one of the things that I think is worth considering is they're going to start doing this thing where it's like, oh, was it a dovish hike, or was it a hawkish? Was it a hawkish pause? So a hawkish pause is like, I'm still going to get you bastards, just not today. And a dovish hike is like, it's so small. Just we're going to do one more, just one more. Like this is where we are now. So maybe you're right, maybe I'm right. I don't know. I think they're gonna it shows, actually, it does give the Fed credibility if they pause, because it shows that they're paying attention to what's going on. Are we gonna do simultaneous rate hikes and bank rescues?
That would be something.
Okay. So, or this idea that the Fed has to hike for their credibility, is there any way whoever is saying that could just stop saying that? Credibility is reacting to the environment and doing what's right, not satisfying someone's opinion from 2 weeks ago before literally the financial system almost melted down. So I don't think they lose credibility by being like, all right, we're going to pause here now that we just had to bail out the depositors of 2 top 25 banks. Like that's where you get credibility from, not making it worse. Oh, can we do this thing?
You know where else well, is it? All right, go ahead. Sorry.
This is Ethan Harris, Bank of America, Securities. Put this chart up. Fed funds target rate, and we talked about Orange County for a second. So there's a little bit of history here after like a big shock, and then like how does the Fed behave itself? So I'll just give you 1987. Take a look at, this is the Fed funds rate, not the stock market, guys. This is Ethan managing around a stock market crash in the mid-'80s. The Fed was gradually raising interest rates in response to inflation concerns. Bond yields were moving higher. And then October 19th, 87, the stock market crashed. S&P fell 20% in one day, was down 28.5% peak to trough. The Fed funds target after the S&P 500 crash of 87, the Fed responds with a 50 basis point rate cut in November and a couple of more following that, and then went back to hiking rates when the coast was clear. And by March of 89, got up to 9.75. So that's a pause. One more. 1998, which I actually was around for. This is managing a fixed income freeze. The crisis of 98 was concentrated in the fixed income market, not in the equity market. This is the Russian debt default. Chart off. Despite a bailout on September 23rd of long-term capital, fixed income markets remained under pressure. The Fed was hiking rates coming into the crisis, but between September 29th and November 17th that year, the Fed cut by 25 basis points 3 times. The economy seemed okay, and then, as we all know, they went back to hiking rates until they really crashed it good in 2000. But like, there is a history of this. The Fed, historically, when there's a big market event, doesn't just keep going because of what the data said 2 months ago. So that's why I feel very strongly that this is the moment for them to stop.
Let me ask you to twist your head into a pretzel. So they're going to stop. A recession is going to come. They're going to pause. Is that bullish for stocks or bearish?
I think bullish for some stocks and bearish for others. Is that a smart alecky answer?
Yeah.
I
All
think
right, good.
I think that's reasonable. I think it's reasonable to say. It's probably not super bullish for Apple, Amazon, Microsoft, whatever, but there are areas in the stock market people are going to buy.
Like Meta.
Recession or not. Yeah, like Meta. Let's do this Meta thing. Mark Zuckerberg wrote a big boy letter today to his employees, and he was proud of it because Facebook shared it to its public blog. Meta shared it, and I thought it was pretty good. This is like an update on the year of efficiency, and it's basically like, look, there's more layoffs coming. We're closing out. Probably lay off 10,000 people by the end of the year, and we're going to close 5,000 open jobs. And it's got a solid rationale. It's not we're doing this because Wall Street wants it. He's basically saying we have.
Yeah, it is.
You really think so?
I mean, he literally said that.
No,
What do you think he said? Yeah, he did.
Our efficiency work has several parallel work streams to improve operational efficiency, dramatically increase developer productivity and tooling, optimize distributed work, garbage collect unnecessary processes, and more. I've tried to be open about all the work that's underway, and I know many of you are energized by this. I also recognize the idea of upcoming org changes creates uncertainty and stress. He's like, look, I know nobody's excited about the layoff part, but you guys are excited that we're getting back to basics and doing tech again. I think this is what the employees who survive want to see. I don't think they want to work at a bureaucracy where nothing gets done. You think I'm wrong about that?
No. I'm not saying that, but he literally said something along the lines of like, this is what investors are rewarding. So no, I don't think that you're wrong.
Where? I didn't read that in this piece.
All right, keep talking. I'm looking for it.
Okay. He said something interesting about remote work that I think you and I can relate to as we try to figure out, our own hybrid model like every other company. He said, we're committed to distributed work. That's what he means. That means we're also committed to continuously refining our model to make this work effectively. Our earlier analysis of performance data suggests that engineers who either joined Meta in person and then transferred to remote or remained in person performed better on average than people who joined remotely. What are your thoughts?
Well, it's funny timing because Apple said something similar. Here's the headline that went across the screen. Apple to delay some bonuses, expand hiring freeze to more roles. Apple more closely monitoring how often staff comes to office. What if, I know you've been really super bearish on commercial real estate lately. What if a recession is bullish for commercial real estate?
I said
is it
that.
too late?
It's ironic. Well, the prices paid are still going lower for, price per square foot. But I said that. I feel like a recession in New York will fill Midtown up faster than anything else because if you have to sing for your supper in person in front of your manager or whatever, you're gonna be there. What are you gonna tell your wife? Oh, I quit my job because I don't feel like going. She's gonna be like, what the hell is wrong with you? What kind of a bum did I marry? Right? So I think if you work at a company that is now judging you based on whether you show up, you're going to show up.
They said something along the lines of they don't want managers managing more than 10 people. I don't remember how many managers Google has. Is it 37,000? Is it 100? I can't remember what the number is, but it's outrageous. Salesforce. So all of these companies are just getting rid of the fat. I don't mean to be crass about it, but that's what they're doing. Oh, one other thing they did.
They made the point that with all of these different teams, there are teams that are creating sub-teams just to interact with the sub-teams of other teams. The way he spells that out, it just sounds crazy.
They are so I don't know who this is. I forget. Sorry. Some product news across the company. We're looking closely at what we prioritize to increase our focus. We're winding down digital collectibles, NFTs for now, to focus on other ways to support creators, business people, and businesses. So that was fast. They went all in and all out.
Oh no, they're not gonna. What do they do with NFTs? I don't even know Facebook was doing that. What did they do? Must have been awesome.
I don't know exactly, but they're stopping it. Anyway, the
shit.
Right. Oh, let's look at some stock charts. This is interesting. I still do own the stock, not to brag. So the first chart is showing since the bottom, and what caused the bottom was the initial wave of layoffs. The stock has outperformed the Qs by a lot.
Look at
since
this.
then. But it's crazy when you zoom out. So next chart is over a year. So obviously the stock was getting killed. It was year over year. It looks like it was down 50 when the Qs were down 25. So it was underperforming by more than 2 times. And it's actually, look at that. Over the last year, it's actually now outperforming. How about
It's
that?
almost as if when the
Crazy
CEO
chart.
demonstrates
Competency.
that he or she actually is interested in running a company and not changing the world, that shareholders get rewarded. It's really wild. You want to touch on this morning's CPI report, or just let people know what it was?
No, we'll go through it quick. Because I know we're running late. So it came in, I think, slightly.
I'm so sorry. I'm getting word that for the first time ever, What Are Your Thoughts has crossed above 2,000 live viewers of the show, and that's really wow. We love you guys. I'm gonna cry a little bit. I feel like I feel like I'm gonna squeeze a little one out in this eye, little tear. No, it won't come. Okay, continue. What did we do on CPI?
Okay, so it came in a little bit higher than expected, but month over month, 0.4%. Let's just go through these charts real quick.
Oh, there it is. All
Yeah,
right.
you got one? Okay.
I really got one for real. Love you guys. Thank you guys for watching.
So the blue line is all items. The red line is what they call core. It's excluding food and energy. Next chart, please. This shows the story quite nicely. So it's going in the right direction. And then the next chart.
I think this gives the Fed the cover it needs to chill out.
Problem is the next chart shows services, which is the bulk of it.
70% being driven by apartments.
Yeah. So so we're gonna get to that next. So Jeremy Schwartz, bless his heart, love you, Jeremy, tweeted, looking at core CPI, you could say 3-month annualized impulse of inflation ticked higher, but updating core CPI with real-time housing data, we now have 5 consecutive months of core CPI printing negative price declines, reiterating the Fed is too tight. So this line is showing. The blue line is what the government reports. The orange line is core with current housing data. The upshot here is that rent and housing is being reported on a lag. It's looking at the last 12 months instead of what we are today going forward. So he corrected for that. And then we have some more charts to show rent because this is really important. This is from Jeff Weniger. He said CPI for rent came in at 8.8% year over year, which is a big contributor to the overall number, but it's being overstated because it's still capturing last year's rent hikes in this year's data. So charts, please.
Chart back on.
So this is the year over year.
How stupid is this? Could you imagine? You're looking at March of 2022 to figure out what current inflation is today?
Okay, but the good news is we have smart people like Jeremy and Jeff to set us straight. Next chart is the same thing, just from Redfin. So rent is rolling over dramatically. So maybe the CPI is actually overstated. Maybe the Fed knows this. In fact, I'm sure they do. Of course they do. And maybe the Fed actually pauses tomorrow. Oh, wait, not tomorrow. A week from today. When is it? Is it a week?
No, you know what they should do? They should wait until They should wait until there's a housing crisis and a commercial real estate crisis and a banking crisis all at once. And then maybe, this whole thing is just so out of control.
Two more quick charts. Average hourly earnings are still negative. This is not good for necessary individuals, but it's good for everyone. Okay.
Yes.
And then, crude oil is rolling over big time, like big time.
Yeah, no shit. It's below where we were before Russia invaded Ukraine and has been below. So what is the what are we doing now? What is the last?
X fell 7% month over month, so it's all good.
I stole Bookvar had a line. He's like, if you have a headache, are you taking aspirin every 5 minutes? Is that the cure? Is that how you make yourself feel better?
That's a good line.
I stole that a little bit, but I think it's a really good way of thinking about it. What is the urgency to keep going without surveying the damage that you've already done with an unprecedented speed of 450 basis points? Okay.
Well done, Peter. All right, I am going to make the case. I'm going to make the case for some duration here. How about that? How about that?
Say more.
So if the Fed pauses, indicating that they're not raising rates anymore, I think you're going to see longer dated bonds yields drop like a rock.
What do you want me? You want me in TLT for this?
I don't want this. This is not advice. I'm not giving you any advice. But just throw up these charts. So the 10 years up top, the 30 years below. This is where all of the juice is. So if interest rates do fall, I suspect they're going to do so in a hurry. And if you want to get some juice out of that, the instruments are long dated bonds. No,
There's a double TLT. Remember that?
Oh, I'm sure there is. But let me ask you this. How do if the curve was so inverted for all of this time, how do 30-year or 10-year, how do rates rise from here? I know that I'm not saying that this is like obvious. Obviously, there's no such thing as an obvious trade. How does this go really bad? Could you see the 10-year going from 3.5 back to 4.5? What would have to happen for that?
Yeah, debt ceiling fight. I don't know. Like I could think of a situation where people sell treasuries. Maybe foreigners dump all their treasuries. I don't know. Like eventually, though, treasuries go back to being the risk-off vehicle. We saw that this week.
Yeah.
Like if you were really scared shitless on Friday, all you had to do was look at treasuries and say, "Oh, wait a minute, maybe bonds work again as a."
By the way,
as
first
an
time
offset.
first time in a long time, because all of last year it was rising interest rates, falling bonds that took down stock prices. So now you had a flight to safety in bonds. So maybe we're back.
All right,
Maybe
let's
we're back.
do the mystery chart and then we'll get out of here. Put on my mystery chart, John, please.
Am I going to get this right?
Yeah, you are.
Okay.
You're very smart. You're smarter than me, so you're gonna get it. I'll give
Is
you
this,
one. I'll give you
credit
one
spreads.
hint.
Credit spreads.
What? No.
Credit spreads?
No.
VIX?
But good guess. VIX. Spot VIX.
Okay.
Give it to me. Look how smart Michael is, ladies and gentlemen.
Well, there's only two charts that look like this. So
I just wanted to make this point. Leave it up.
Yep.
Like as scary as the last 3 days have been, not really. Not really. Doesn't really register for me. So when you're like, hey, we should send out a letter to all our clients letting them know everything's okay, I'm like, you know what? Let's talk at VIX 30. Like let's give it a beat because this just wasn't that scary.
Okay.
So,
all right. Listen, maybe it wasn't that scary for you, but there were a lot of people that were scared. But I agree with you in terms of the market's reaction. Look at JNK. No reaction whatsoever.
Right.
Look at bank loans did bad. Never mind. I take that back. As I guess you would have expected that too. But credit spreads they didn't go anywhere.
Yeah. They didn't blow out.
So the market was saying no contagion.
I agree. All right. Well, listen, guys, I want to say thank you for 2,000 live viewers.
Thank you.
Subscribe. Subscribe to the channel. Like the channel. New Animal Spirits first thing tomorrow on your favorite podcast platform when you wake up. And we will see you guys at the end of the week for another kick-ass The Compound and Friends. Shout out to Duncan, John, Nicole. Great job tonight. Sean,
Good night.
We'll see you soon.